Hi, and welcome to the eCIO third quarter market commentary. The third quarter was a great quarter for investors as stock indices were up 4 to 12%, bond indices up 1.5 to 2%. That takes year-to-date results for stocks up double digits in many cases, and for bonds up 5 to 6%. Over the past 3 years, stocks have compounded out at over 15% annualized, while bonds have compounded out at nearly 5%. Over the past year, the S&P 500 has gained 17.6%. It has been volatile, starting in mid-February with concerns over trade and tariffs, leading to about a 20% decline, followed by a 34% rebound to record highs. From a sector perspective, technology and communication services stocks led the way higher, while some of the value-oriented sectors tended to lag during the quarter, including financials, materials, and real estate. Overall, we saw the markets move higher, led by the AI hyperscalers. Those are the big technology companies. We did see broad-based gains across both growth stocks. The Russell 1000 growth was up 10%, and value stocks, the Russell 1000 value, up over 5%. International and emerging market stocks also advanced nicely. Bond prices gained as yields fell, reflecting the Fed's action in September, as well as a decline in longer-dated interest rates during the quarter. The 10-year ended the quarter at about 4.16%. From a data perspective, the Fed did cut rates the first time since late 2024. That was in response to a cooling jobs market. Inflation, however, remains a concern for the Fed. CPI was reported at about 3%. Despite this fact, markets are assigning about a 90% probability that the Fed cuts again in the month of October. As most of you know, the federal government did shut down today, October 1st, as Congress failed to pass funding. That will result in about 750,000 federal employees furloughed. Essential services are expected to continue, and overall markets have responded pretty calmly, perhaps because in past shutdowns, there hasn't been a big impact on the economy. Consumer sentiment also weakened in the third quarter, tied mostly to job concerns, and we reached our lowest level since April when we had those tariff concerns. On the business front, sentiment did show improvement. However, CEOs and small business owners are a little less pessimistic, but they're remaining pretty far from being optimistic amid lingering policy concerns and concerns about rising costs. So as we look forward into the fourth quarter, we think investors will be closely monitoring the jobs market, consumer spending, the Fed, inflation progress, and economic growth signals. Additionally, geopolitical risks and trade uncertainty will likely add volatility to the markets. So that's a quick update for performance in the third quarter. I'm going to take a deeper dive into some of the things that drove the market in the third quarter, so stick around if you have a few minutes. We'll start with stocks. First of all, the performance of the S&P 500 was largely driven by the so-called Magnificent Seven. These are the big technology companies that are spending significantly on artificial intelligence. When we look at the S&P 500, it returned about 10% year to date, as I mentioned. If you take out the Magnificent Seven, the index would have returned 6%, and those seven stocks returned about 11%, accounting for almost 40% of the total return. You can see in 2023 and 2024, it was even more significant, where those Mag 7 stocks were up 76 and 48% respectively. So as a result of that, the top 10 companies in the S&P 500 now comprise almost 40% of the index, and that was as of August 31st. We don't have this chart yet updated. So you can see it's an all-time high. In the internet tech bubble, those top 10 companies comprised about 26, 27% of the index. And then for the next 15 years, they underperformed the market, which is why this gray line goes down. So this time we're up at a new record high. Now, this is somewhat justified because this green line represents the earnings from those top 10 companies. So the top 10 companies comprise about 40% of the index and have contributed about 32% of the earnings. So there is a disconnect, but maybe not as great as what we saw during the internet bubble. That has resulted in the top 10 stocks trading at a pretty high price earnings multiple, approximately 30 times earnings. That means investors are paying about $30 for $1 of earnings for those top 10 companies. That compares to a longer term average of about 20. So about 144% of the long-term average. If you look at the remaining 490 stocks, they trade at about 20 times earnings. And so when you put those two together, the S&P overall trades at about 22 times earnings. As mentioned, that has resulted in a disproportionate amount of the large cap indexes being exposed to technology. And so that's what you see here. By sector, large cap is in gray, mid cap in green, and small cap stocks. So large cap stocks indexes are about 33%, about a third of the index now is technology stocks, whereas small and mid caps are more reasonable, kind of 10 to 15%. And you can see some of the other sectors' exposure. So this is one reason why we're suggesting investors maintain a diversified portfolio so you're not overly concentrated to some of these companies that have appreciated a great deal and are trading at rich valuations. Now, when we look at the big technology companies and what's going on with AI, it is significant. This is the money, the CapEx, capital expenditures, from the major AI hyperscalers. Those are 4 companies. That's Alphabet, which is Google, Amazon, Meta, which is Facebook, and Microsoft. So last year they spent $200 billion on CapEx, mostly on AI. This year we're expecting them to spend $315 billion, and this number has gone up since we last updated this chart. So that represents about 70% of their operating cash flow. And looking out into 26 and 27, that number is expected to go up even higher. So very significant spending on AI. And obviously, there's a lot of demand for the AI services. Now, when we look at businesses that have rolled out AI to produce goods and services, overall, only about 10% of the businesses have. Over the next 6 months, this gray line represents what's expected. And then you can see by sector, it varies quite a bit. So the technology sector is rolled out the most. And then you can see some other kind of professional, financial services, insurances, which are very conducive to AI, are rolling out fast, but there's a long ways to go. Conversely, there's some sectors which aren't that amenable to artificial intelligence. Think about restaurants and some of those services, very low penetration there. We'll see all of these move up, but some sectors just won't be able to use AI that significantly, while others will. So a lot more to come on that front. Turning to the Fed, as mentioned, the Fed did come into action in September, cutting rates. This is the Fed funds rate over time in gray. You can see this is where we were before the cut, so this chart has not yet been updated. The Fed did cut 25 basis points, and the green and blue represent expectations. So the market is expecting the Fed to get down to about a 3% Fed funds rate. And there's about a 90% probability the market's placing for an October cut of another 25 basis points. Now, the Fed is in a difficult situation because they need to support a stable job market as well as stable prices or stable rate of inflation. When we look at the job market, it has deteriorated. These are non-farm payroll gains over time. This black line represents the 3-month average. You can see that's come way down. So we had a big rebound coming out of COVID, and then that's come down as far as payroll adds to a relatively low level. So it looks like the job market is relatively weak. You can also see that when you look at job openings, they've fallen from a peak in March of 22. This was June of this year, almost in half. And we believe this has continued down. We'll have a new graph shortly. But so weakness in the job market overall. So that supports the Fed to cut interest rates. Offsetting that is inflation. And this is the consumer price index over time, broken down by component. So you can see what's driving it. July, the print was 2.7%. August, we inserted here, was 2.9%. And the vast majority of that inflation is coming from shelter. So that's your housing here in dark blue. And then in light blue, this is dining and recreation and other services. So that's what's that's what's driving the inflation, those two sectors, quite significantly. So this is holding the Fed back a bit because they want inflation to be at about 2%. So you have diametric forces there that the Fed is going to have to weigh out and make a decision on in the upcoming weeks. Now, when we look at bond returns and expectations for future returns, this chart maps out over time. Each of these dots represent an observation of a starting yield and then the subsequent 5-year return. And this line here is a regression line that shows the average relationship between starting yields for the bond market and returns over the next 5 years. This has a very strong relationship, 90% correlation. And here's where we're at today. This implies a 5-year average return for bonds of about 4.5%. Now, we've already seen a 5 to 6% return in the first 6 months of this year. So we would caution you a little bit to expect over the next 6 months a more modest return. But nonetheless, over the next 5 years, an average return of about 4.5 to 5% is certainly reasonable to expect from bonds. Stocks, on the other hand, are trading at a relatively rich level. This is the S&P 500 index, and it looks at the price-earnings ratio over time. That's the gray line. The 30-year average has been 17, meaning investors have, on average, paid about $17 for $1 of earnings. As of the end of August, we were at 22 times earnings. And you'll recall from the earlier chart that's skewed by the big technology companies, which are trading at more like 30 times earnings. And then the non-technology companies, the non-big tech, that are trading more at about 20 times earnings. Nonetheless, this suggests a much more modest return for stocks because of the relatively rich valuation levels. So we would tamper down expectations for stock returns. Having said that, there is some positive news out there. And this is a chart we've shared in the past, which looks at consumer sentiment and subsequent returns in the S&P 500. It graphs out consumer sentiment over time. When the line is down here, it means consumers are pessimistic. And when the line is up here, they're very optimistic. And when we look over time, the peaks when consumers are very optimistic, future returns over the next 12 months average about 4% for the S&P 500. Conversely, when they're pessimistic, and that's a time you don't feel like owning equities, the market has actually done very well, up an average of about 24%. So where are we today? We're down in the more pessimistic area. And again, we mentioned, that can be attributable to the soft job market, probably raising costs that are moving up for consumers also come into play. But that tends to bode generally pretty well for the stock market. And certainly it has been on a year-to-date and really past 12-month period. So that's a quick update. We have much more to share with your investment committee. If you're interested in meeting with us at any time, just let us know and be happy to schedule that. Thanks for your time and interest, and have a terrific day.